All right, guys, warm welcome to a brand new week ahead. Now, before we get to the calendar, which is looking like a little bit of a snoozer, to be honest, coming into the new week, before we start there, let's maybe just take a step back and look at some of the beautiful moves that we had played out in this past week, obviously on the back of the FOMC policy decision that we had on Wednesday. Now, in terms of the way the markets reacted into as well as out of the decision, it's important, just like we mentioned in last week's week ahead video, it's always important to understand how the markets are pre-positioned and how they are priced going into any economic data point or any risk event like a policy decision. And when it comes to the FOMC, like the FOMC was a classic example of the markets getting a little bit too offsides on one direction and then being disappointed based on what they had pre-positioned or what they had priced for. What do I mean by that? Well, as we explained last week in the week ahead and in the event prep that we did for the FOMC as well, we focused on a couple of things, right? The first one was the clear pre-positioning that was clearly dovish going into the decision, right? Coming into the decision just on Wednesday itself, the dollar had a huge sell-off from the start of the week, even more than I anticipated. We normally don't see the markets, pressing on the pedal that much as they did ahead of a key event like that. You normally see the markets kind of just treading water. So the fact that they pressed into new shorts ahead of the event, it just added to the risk of whatever the FOMC would have done being a bit of a damn squib, right? Being a bit of a letdown, underwhelmed, if you will, in terms of dovishness, because the markets were just so dovishly priced already going into the decision. So that pre-positioning to the downside in the dollar was a very key thing that we were focusing on. The downside in yields pre the event was a key thing that we were focusing on as well. And I mean, apart from that, if we take a quick look at rate expectations, let me just bring that up. We knew from a rates pricing point of view that the markets were already fully priced for 3 potential cuts this year, as well as 3 fully priced cuts for next year as well. So the markets were already priced for 6 cuts in total by this time next year, by the end of next year. So there was already a lot of dovishness in terms of just the pure pricing as well. So pre-positioning was dovish, and then obviously the rates pricing was dovish coming into that as well. So what exactly happened out of the decision? Well, if we quickly take a look at our event prep for this, there's a couple of things that came in as expected. There was something that was slightly leaning more towards the dovish side, but for the majority of things, it came in a lot less dovish than what the markets had anticipated. So what did we get? We obviously got the 25 basis point rate cut, which was fully priced, fully expected. That was not going to be enough to move the needle. What we got, in fact, though, is a as expected 2025 dot plot revision, right? If we go to the dot plot here, we got the 2025 dot revised from 3.9 down to 3.6. Now, that was completely in line with what the markets had already priced by the end of the year. That is very important, because when that happened, there was no reason for the markets to want to press dollar shorts on the back of that, because that was already fully priced and fully expected by the markets. However, when we take a look at what rates markets were expecting by the end of next year, which was a rate closer towards 3% for the federal funds rate, then suddenly the hawkish reaction that we got after the initial sell-off makes a lot of sense, because there we can see the 2026 dot was revised up, or was revised down from 3.6 to 3.4, but that 3.4 was nowhere close to the 3% or even the 2.9% that rate markets had already priced in ahead of the event. So in terms of the dot itself for 2026, that actually came in more hawkish than what the markets had anticipated. Furthermore, and this is really what set the tone and the mood for the market's reaction after the initial short-term reaction, was the overall very optimistic outlook from the Fed about the US economy. Take a look at GDP. GDP for both 2025, 2026, and 2027 was revised higher from 1.4 to 1.6, 1.6 to 1.8, 1.8 to 1.9. Furthermore, the unemployment rate, which is obviously a big focus point right now, and everybody is focused and concerned and scared about the labor market, the Fed actually lowered the unemployment rate expectations for 2026 and 2027. Furthermore, for next year, they're pricing in a slightly or expecting a slightly higher profile for core PCE as well as headline PCE inflation. All of that combined together makes a lot of sense for why the markets decided to pop the dollar higher at the after the FOMC, because there's just no reason for them to feel negative about the dollar, given this more optimistic outlook about the US economy, and obviously the fact that the Fed didn't signal as many cuts for next year compared to what the markets had priced. What the Fed basically told us with these revisions is that they see the US economy in much better shape than anybody anticipated, right? Obviously, assuming that they stick to this amount of cuts that they are currently pricing themselves in for. Furthermore, at the press conference, Fed Chair Powell also said that they're not cutting rates right now because they're scared about the economy. They're cutting it more as insurance-based cuts, right? They're cutting because they have the freedom to cut. They're not cutting because they think they're falling off a cliff. They're just doing so to try and preempt some potential further softening in the labor market. And obviously, what he also said, and this is the important thing, right now, they don't foresee the start of a massive, big easing cycle as so many had anticipated. He actually sounded a lot more optimistic. Now, did he sound a little bit more concerned about the labor market compared to previously? Of course he did, and that is backed up by the recent data. But in the aggregate, the bottom line is that the Fed just wasn't as dovish as the markets had pre-positioned for or pre-priced for going into the event. So when we then take a look at how the dollar reacted, the move makes a lot of sense. We had that first initial sell-off, which was a little bit of a weird one, but probably on the back of that 2025 dot being lowered. And then we just saw the dollar ramping back to the upside following the decision, following the press conference, as the markets realized, but wait a minute, this isn't as negative as we previously thought it would be. Now, where does that leave us in terms of major assets? Let's start with the US dollar, because I think this one is the most important one. Right now, and after the FOMC decision, there's just very little good reasons, in my opinion, to want to short the US dollar right now. Let's talk about why that is, right? Firstly, we know that we have a less dovish Fed than what the markets had previously anticipated. Not just in terms of their projections, but obviously in terms of where they see the federal funds rate going. The Fed just isn't as concerned right now as the markets thought they would. There's less cuts now being expected compared to what was expected going into the decision. That's one reason to not to want to be short the US dollar. The other one is we know the markets was already very pre-positioned on the dovish side, on the bearish side for the US dollar going into the FOMC. So now that the FOMC has come out and not being as dovish as everybody thought, then obviously that gives you no reason to want to press shorts if the thing that you expected didn't materialize. Furthermore, and this is the most important one, let's just look at the raw economic data and what the markets are expecting, right? Let's look at GDP, for example. The GDP nowcast for the Atlanta Fed is still tracking at 3.3% for GDP for Q3. Show me any other major economy right now that is sitting on the same amount of solid growth profile. I mean, the Q2 GDP is expected to print at another 3.3% this week. Right, so you've got Q2 at 3.3, you've got Q3 at 3.3. What's not to like about the growth profile for the US right now? It's looking solid. Apart from that, inflation, even though it hasn't been, jolting higher as many anticipated, it's still staying sticky at the current levels, right? If you look at things like core PCE data, which we'll be getting on Friday, if you look at what the markets are expecting from that, it's still looking at core PCE close to 3%, right? That's no reason to want to be short the US dollar. Apart from that, if you take a look at the raw data surprises that we've had recently, on the left, we've got the US City Economic Surprise Index, and on the right, we've got the G10 minus the US. Take a look at the very different growth profile for everything apart from the US. Everything else has kind of been stagnant and trending lower in terms of economic surprises, while the US, apart from that recent push to the downside, has just been trending higher and higher and higher all the way from August, right? So think back to a couple of months ago, back to April. Back in April, everybody assumed that the US economy is going to go face a massive hurdle. It's going to take a massive bump as a result of all of the tariffs and, how that is going to pass through to the economy and all of those, negative doomsday stuff, it didn't materialize. Growth is looking fine. Inflation is still sticky. The Fed isn't expected to cut rates as aggressively. There's just very little reason right now, in my opinion, to feel excited about getting short the US dollar, especially when you compare it to other places like the UK or New Zealand or the Eurozone. There's just very little reason to get excited about wanting to short the dollar against the currencies for countries like that. Now, the way that I'm the way that I played that is when I saw the reaction the following day, because the FOMC happened 4 a.m. my time, so I wasn't there live. Looked at this the following day. I got into two different trades. The first one is a dollar CAD long. The other one is a dollar index long, because that basically gives you a slightly broader spectrum to trade against as opposed to just one currency. Now, unfortunately, fortunately, I would say the dollar index trade is moving well. The dollar CAD, though, had a very weird reaction to the downside. Why did I choose the dollar CAD as a long in the first place? Well, between these two economies, the US and Canada, there's a very big divergence between these two right now. For all the good reasons that I just explained about the US economy, we've got very bad ones in Canada. The bank cut rates, there's expected to be more cuts. Growth is looking very bad. Labor market is looking very bad. Inflation at the same time is high, which is bad in the current context because they're facing a bit of a stagflation problem. However, the CAD saw a huge jolt to the upside on Friday. I mean, the move, just to put that into context, if I bring up this currency strength chart, the pink line that we have here, that is the CAD. It just got a huge rush to the upside. And to be honest, I just don't have a good answer for why we saw that move. I've looked at so many different things, and right now it seems like the consensus believes it's either one of two things. It was either some possible trade deal hopes that is resurfacing for Canada, between the US and Canada, which obviously would make sense for a little bit of strength flowing through into the CAD. And on the back of that, there's some big desks who basically commented in Reuters articles who state that they think it's just them alongside other people, big desks taking profit on Canadian dollar shorts, basically, which forced the CAD higher. Does that change my view about the Canadian economy? No, it doesn't. Can it impact the trade negatively? Of course it can. It already has, right? If we see some real good progress between the US and Canada on a trade deal, then of course the dollar CAD can push lower, and then of course that trade could be a losing trade. But right now where we're sitting, it's very difficult to not argue that there's a higher probability for a higher dollar CAD as opposed to a lower dollar CAD. Again, barring any massive trade deal progress that could potentially be made between those two economies. Now, the real big trades to have chosen, obviously I've picked a slightly slower horse, it would seem, with the dollar index, but better trades would have been pound dollar downside, especially on Friday. The pound got smacked on Friday. I mean, if I show you that same currency strength chart, this light blue line, that's the pound. The reason why the pound was the worst performer, especially on Friday, was just some pretty ugly borrowing data coming out of the UK. I mean, what the data showed us on Friday was that between April and August, the UK government borrowed close to 84 billion pounds, right? That's about 10 or 11 billion more than what the OBR previously projected that they would borrow. August alone was freaking ugly. They borrowed almost 18 billion pounds. That's way above the expectation. So why is that a problem for the markets? We've been talking about gilt yields and the negative impact that has had on the pound for quite a while now. And we saw that same relationship play out again, where yields pushed to the upside and the pound pushed to the downside. What's happening here is that higher borrowing on the government side means that the government is spending more than it's pulling in. And that is putting pressure on UK finances. It's also putting pressure on Finance Minister or Chancellor Rachel Reeves ahead of that big November budget, because right now the markets is looking at this and saying, okay, you are digging such a massive hole for yourself with this borrowing. How are you going to make up the money? How are you going to stick to your fiscal rules? There's only one of two things or both that needs to happen. She either needs to cut taxes a lot more than what markets had anticipated, or she needs to cut spending, or worst case scenario, a bit of both of that. And none of those two things is positive to pound. So the pound had a big push to the downside. And you know what? Unless she brings out something that's really good news, there could be further downside potential for the likes of the pound dollar. So apart from just dollar index upside, pound dollar downside would also be one of the biases that I'll be looking at for possible opportunities in the week ahead. And we'll touch on how that fits into the week ahead in a second. And then apart from that, the other good trade would have been Kiwi dollar downside. I mean, the Kiwi had some very ugly Q2 GDP data coming out last week, and that just flushed the Kiwi lower. And obviously on the back of dollar strength, it was a monster move. I mean, in terms of distance here, guys, from top to bottom was it's a 2.6% move. That's massive. That's massive for a 2-day move in something like the Kiwi dollar. So those were really the big movers for the week, but obviously the dollar in aggregate had some pretty decent moves to the upside. So what about other markets? You know, when it comes to equities, this one was an interesting one because I had a lot of questions about this one saying, hey, with the dollar up and the Fed less dovish, why isn't equities lower? And we spoke about this in the week ahead as well as the event prep for the FOMC. The reason why you wouldn't expect equities to have drifted lower more than it did initially with that push lower is because we spoke about this, right? What does the Fed, even if they were slightly less dovish as they were, what does that mean for the markets? The markets are still pricing in rate cuts. Right? The Fed expects to cut a little bit less, but they're still cutting rates 3 times this year and 1 or twice next year. That is, in the aggregate, still good for equities. And all of the other reasons why you would like the US dollar right now, you have to like something like equities as well. Inflation isn't massively high, it isn't massively low, but it's a little bit sticky, but it's not accelerating massively. Apart from that, you've got the growth profile that is still looking really, really good. Right, you've got economic data that's been surprising to the upside. So for the same reasons that you would like the dollar, for those same reasons, you would have expected the buyers to step back in and say, hey, wait a minute, we've got rate cuts and good growth and inflation is not accelerating. What's not to like about that, right? So not surprised to see the move in equities at all on the back of that decision. The one that was very surprising, more so on Friday, was gold. Why do I say that? Well, firstly, normally when we see upside in the US dollar, that leads to downside in the gold, right? We normally have that inverse correlation between the two. It has been a little bit hit and miss, to be fair, over the past couple of months, but that correlation normally stays true. We didn't see massive downside in gold apart from that. Now, one could argue that for the same reasons that equities do well, on the rate cut side, gold should do well as well, because yes, even though the Fed isn't going to cut as much as everybody thought they would, at least for now, they are still cutting rates, and that should still be positive for real assets, things like gold. Even though that is true, when you combine that with a much better growth profile in the US, the move is a little bit strange. What do I make of this? Look, gold has been on an absolute tear for what's it been now? Let's say 8 months. I think momentum is just still massively strong. The market is looking at the Fed saying, you know what? Yes, they're not going to cut as much as we thought, but they're still cutting rates. On the aggregate, that should be a positive. I would feel much better looking for long opportunities in things like equities as opposed to things like gold, just purely because I am expecting more strength to play out for the dollar. But, so I'm not so excited about looking for upside in gold. I'm a little bit more concerned about that. That one was a bit of a surprise. But we are currently, we are a stone throw away from another all-time high, which is currently sitting just above that 3,700 level. So where does that leave us then for the week ahead? Look, in terms of economic data points, there's very little to get excited about, honestly. I mean, what we do have a whole week of next week is a ton of central bank speakers, and there will be a lot of focus on what the Fed speakers have to say. Obviously, a lot of them will come out explaining why they voted the way they did, which one of the dots in the dot plot is their dot, right? Why did they vote for that particular number? Where do they see growth going? Where do they see unemployment? Where do they see PCE? The markets will be grilling them, or interviewers will be grilling them on their takes, and we will get a lot of takes. And obviously, if it comes in more dovish than what the markets are currently priced in, or sounds more hawkish than what the markets are priced in, that can have a reaction. So that will be the first thing to be aware of for the week ahead. There's no way to prepare for that like we would an economic data point, right? We basically have to wait for the comments and then see how the markets interpret them and see if there's opportunities to trade. So not something that I would be too excited about trading, but something we definitely need to be aware of for the week ahead. Apart from that, coming up on Tuesday, we have a new batch of flash PMI data. Normally, the biggest ones or the most important ones would be the ones for France, the ones for Germany, the ones for the UK and the US. Now, given the information that I've just spoken about for the US dollar, I only really see one way that I would look to trade something like the flash PMI data, and that is if we were to see bigger than expected downside or misses in the French and the German data and hopefully the UK data, I would be looking for opportunities to trade things like the euro dollar lower or the pound dollar lower if the euro and the UK data surprise to the downside. I think that is for me the simplest trade after last week and after the pre-positioning. That for me would be the simplest trade to look at for the week ahead. What if the data comes in really hot for the euro and for the UK? Then I'm just going to ignore it, right? I don't want to be long something like the pound right now on good data, or long the euro for that matter, but I would like to get short them if the data comes in really bad. If it's really good data, I'm just going to ignore the data point altogether because I just don't see scope for a trade if it's hot data, not in the current context. And then obviously we have the US flash PMI data coming up as well, and we can look to pair that. If that comes in super strong and these ones comes in super weak, it just gives me another reason to want to trade the US dollar to the upside. Now, apart from that, we also have some Aussie CPI data coming up for the week ahead. Now, I just don't know how important this one will be for the markets, not after the most recent two central bank decisions that we had. Why do I say that? Well, at the most recent central bank decisions, the RBA came out and they basically told us that they're not really too focused on the monthly metrics that we get for weighted CPI as well as the trimmed mean. They are more focused on the overall trend of the quarterly GDP data. Now, in their defense, the monthly data can be very noisy, but in the same time, you just have to look at the trend, right? You can't say that the monthly data isn't something you want to consider. You only consider the quarterly data because the trend is your friend and the trend speaks volumes about how quote unquote accurate or non-accurate these data points have been. Bottom line is, because we know the RBA is more focused on the quarterly number, the monthly numbers just don't have as much of an impact. Can it be market moving? I mean, currently the markets are still expecting inflation to stay slightly elevated on the weighted CPI from 2.8 to 2.9. That's mainly due to energies. We saw the same thing happen with the prior print. Some of that is expected to dissipate over the next 2 months worth of prints. So it's probably not going to be as big of a surprise. If this thing should start punching above 3%, then obviously maybe that matters a little bit more and maybe that could see some upside in the Aussie dollar. But all in all, because we know the RBA isn't too focused on that, I just don't know whether that's going to be worth focusing on in the week ahead. Obviously, something we'll be watching, but probably not something I will be looking to trade. Now, apart from that, we do also have the SNB policy decision coming up. Everybody is expecting that to be a complete nothing burger for the week ahead. Let me just quickly show you here. Looking at rate pricing, there is a whopping 1 basis point price for this meeting, which just basically means there's a very low probability of anything happening, right? The markets are fairly comfortable that we're going to get something that is close, that we're going to get a hold. We're very close to 100% price for a hold. Why are the markets so confident? Well, due to 2 reasons. Firstly, a week or 2 ago, we had the SNB governor coming out telling us that, or chairman coming out saying that they are in no rush to move rates into negative territory again. Everybody expected them to move into negative. They came out saying we don't have appetite to move into negative. So nobody's expecting them to do that, especially when nobody is expecting them to do it, right? So that is one thing why the markets are pretty sure we're not going to get any movement. Apart from that, if you look at inflation, do I think there is deflation risks in the Swiss economy? Absolutely. We've been saying that for the last 2 years, and inflation has just been drifting lower. I mean, we are close to 0 on the headline number. But what has the SNB done? The SNB has taken the sting out of inflation data completely. Because if you're in the S&B, even if you're facing deflation risk, what they've done, they've simply just upped their forecasts over the next 2 years to a much higher inflation number, and that gives them the freedom not to do anything on rates. And if we challenge them on that, they just say, oh, well, we expect inflation to go up in the next 2 years, so we're not going to move policy. So with that in mind, nobody's expecting anything. And there is some participants, I have gone through a few previews, there's some participants who think that because of the persistent strength we've had in the Swiss franc, that maybe the bank tries to jawbone the currency a little bit, but the Swiss franc has been too strong for them for the last 2 years now, right? Could this be the meeting where they start talking down the Swiss franc? Maybe, but I would definitely not be holding my breath for that, not given the recent history that we've seen from this bank. Apart from that, we get another batch of GDP data, but remember, this is the final data for Q2, so it probably doesn't matter. The jobless claims data could be interesting because last week we moved down from that big scary number. We saw a very, very decent mean reversion. Let me just show you guys what I'm talking about so that we're all on the same page. Here we go. So that was that scary number to the upside, 264 new cycle high, boom, all the way down to 231, just like we've seen it happen so many times. What could matter to the markets? Look, if we print something above 264 again, maybe that matters. But as long as we stay within that same bracket between 261 and 200 to the downside, it's probably not going to be something the markets will be focused on. We also have some Tokyo CPI data coming out for Japan. Now, the reason why Tokyo data is more interesting than the national data is because Tokyo data comes out 2 weeks before the national number, and it has a very strong correlation between the national number. So if we have a big upside or downside surprise in the Tokyo number, that normally dictates how the markets feel about the national number. So that could be something to watch out for the yen. But given the recent political changes, the BOJ's hands are pretty much tied in terms of policy. So it's tough to see the markets getting excited about that print because there's not much the BOJ will be able to do until they get more clarity on the political side. Then something that will probably also be a nothing burger is the PCE data coming out of the US. Look, right now the markets know that the Fed is more focused on the labor market than it is inflation data. Inflation data, as long as it stays fairly close to what the markets are anticipating, it probably doesn't matter. It probably doesn't move the needle. So bottom line, I think as long as potential month-end flows or the PMI data, as long as that doesn't derail things drastically in the week ahead, I would expect the markets to find more reasons to trim those prior dollar shorts. I mean, if you take a look at positioning data, for things like the euro is still sitting in stretch long territory. If you take a look at the dollar, it has moved out of stretch short, but there's still room for short players on the dollar side to trim their exposures. And I would expect, again, if there's nothing to derail that view, I would expect the markets to find some reasons to trim their dollar short exposures, which could see some upside drift higher for the US dollar. Now, I shouldn't have to say this, but as always, please remember, as I've said many times before, the info that I'm sharing in these videos, whether it's the week ahead video or whether it's the preview videos, these are all my own personal views, right? This info it's not a solicitation for anyone to do the same. You should have your own view, make up your own mind about what you want to trade. I like the dollar on the long side. I have shared my thoughts and my views for why I think that's the case. But I have been wrong many times before, right? So just keep that in mind when you listen to this. If anyone out there wants to trade the same things that I do, you do so on your own accord and you do so at your own risk, right? This is my view. It's my trades. It's the way that I'm viewing the markets. I have been wrong. I can be wrong again. So please always just keep that in the back of your minds. So with that said, good luck for the week ahead. It's going to be, like I said, a bit of a snoozer. I'm not expecting these risk events to massively move the needle, which is why I'm comfortable, holding on to the current bias that I have. But again, obviously take that with a pinch of salt. Let's see what the data shows us. Let's see what the Fed members tells us. Maybe they tell us something different and we see the markets move in the opposite direction. So with that said, hope everybody will have a fantastic week ahead. And as always, any questions, don't hesitate to let me know.